If you like our video, click the button to subscribe to our channel and get easy access to new content. To see our full suite of ad-free video courses, instruction manuals, and quick reference guides, visit us at www.teachucomp.com. Equity is basically the difference between what you have, your assets, and what you owe, your liabilities. If you sold all your assets today and paid off your liabilities using the money received from the sale of your assets, the money you'd have left over would be your equity. A balance sheet shows the company assets, liabilities, and equity on a particular date. Because equity is the difference between total assets and total liabilities, it's also true that total assets equal the sum of total liabilities and equity. As you enter the opening balances of your assets and liabilities while creating the company file, QuickBooks calculates the amount of equity and records it in an equity account called Opening Balance Equity. In addition to the Opening Balance Equity account, QuickBooks often sets up another type of equity account for you called Retained Earnings. This account tracks your company's net income from previous fiscal years. QuickBooks automatically transfers your profit or loss to retained earnings at the end of each fiscal year. If your company is a sole proprietorship, you don't have to add any more equity accounts to your chart of accounts. All the equity belongs to the company's sole owner. If your business is a partnership, you'll probably want to set up separate equity accounts for each partner. Remember to click the subscribe button to see more of our videos. See our full suite of courses, instruction manuals, and quick reference guides at www.teachucomp.com.